So, hello everyone, and welcome to this latest edition of the BNE IntelliNews podcast. I'm Alexander Kabanovsky, your host. Co-hosting with me is Ben Aris, the chief editor of BNE IntelliNews, and we are very pleased to welcome Stephen Diehl to the podcast. Stephen is a London-based software engineer. He is the CTO at ZeroLink AI in London. He is working in the financial sector and is known for his critical stance on cryptocurrency and Web3. In addition to his professional work, Stephen is an active writer and commentator on these subjects. His book, Popping in the Crypto Bubble, delves into the history and impact of cryptocurrency. He also maintains a blog where he publishes a very interesting commentary on cryptocurrency, its current and future, and opines on what it's all about. Stephen, welcome to the podcast. It's lovely to have you.
Lovely to be here today.
Welcome. We met 2 years ago at Kilconomics, and you were put up against some very big crypto optimists, and I don't know where they are today, but it's certainly lovely to see you here. And we would like to discuss and give you the opportunity to discuss what is happening in the world of cryptocurrency today. And the reason why we thought that this could be an interesting topic to delve into today was because over the last, I think, 4 months, or actually 2 months since the start of the war in Gaza, the price of Bitcoin has gone from something around $20,000 to the current $42,000, and it's an interesting story that's developing. We thought we'd give you a chance to offer some commentary and your opinion on where the status of crypto today and where it's going in the future.
Yeah, I mean, certainly it's been a very interesting year. Ever since we met in Kilconomics, a good chunk of the crypto industry is either insolvent or in jail. And there's been a lot of very interesting developments on the legal front, on the regulatory front. And obviously there's some interesting behavior of the price in the last couple of years. And they all seem to be sort of uncorrelated with pretty much everything. And crypto is sort of an asset class that is a purely narrative-driven instrument that trades only on sentiment. And as a faith-based asset, its price behavior is sort of extremely unpredictable. And it is precisely what the next person will pay for it. And it is a scheme basically built on bringing more and more investors into the scheme based on an ever-shifting, changing set of narratives. And recently the narrative has been that this is some sort of hedge against inflation, or it's an escape from the dollar, or it's building a new internet. And these things cycle like every couple of years. Every time the price goes either down or up, and they cycle to a different narrative. And crypto is at its core basically a purely narrative-driven asset class based on a set of logical contradictions. And that's my broad thesis about what's happening in the crypto market.
So can I ask a simple question? In so much as, I don't know anything about cryptocurrencies in so much as, well, we write about them, they get talked about, but specifically trying to understand it. If I look at the ruble and I look at the trade goes down, the ruble goes down, and trade goes up and the ruble goes up. But specifically with the war in the Middle East now, why has it doubled in value? What's the connection between the war and suddenly Bitcoin becoming more valuable?
Well, I think it's a bit fraught to actually tie the price behavior of Bitcoin to literally anything, because it's effectively like a gambling product. It's a pure, naked, speculative instrument, completely untethered to basically anything in the real economy. It's driven almost exclusively by gambling interests, some institutional gambling interests nonetheless, which can cause massive price swings. But it doesn't function as a currency. As an asset, it has no underlying, there's no actual cash flows. It doesn't generate a yield from any productive economic activity. It's purely naked speculation. And so I think there might be some bit of a fallacy to kind of tie it to broader macroeconomic events, because the only thing that really drives the price of Bitcoin is sentiment and gambling and speculation. So it can go up or down, and there are things that will happen in the world that it could be correlated with. But to say that it's caused by those events, I think, is a bit specious.
So it's like herd mentality, in so much as, I mean, inflation, you said in your preamble that inflation hedge is something that it could do, and obviously inflation is high. So that creates a story whereby I can protect myself from inflation by going and buying Bitcoin. And then because everybody's doing that, the value goes up, and then you feel clever because, you know, you've made money, but you haven't made money from the stability of the coin. You've made money from the fact that the value's gone up, and it's just everybody's come to the same idea at the same time. Isn't that the way it works?
That's a bit of it. I mean, there's this story that Bitcoin is a hedge against inflation. I mean, it's not borne out by the data, because obviously in the last, like, the regime that we have the most data on is like the last 2 years, we saw this massive increase in inflation across the West. And what happened to the price of Bitcoin? It collapsed. So, if inflation is going up, it's not a flight to safety, because Bitcoin collapsed during that period. And also, like, the volatility of Bitcoin is an ever-present phenomenon. It's always volatile. So if you want to have like an asset class that when inflation is high, it has low volatility, it doesn't exhibit that behavior either. Nonetheless, people really want it to be a hedge against inflation, and they're willing to trade that thesis regardless of the data. And that creates this sort of herd mentality that can create these sort of massive speculative bubbles that can keep going up and down and up and down. And that's what Bitcoin exists to do. It's a form of gambling, effectively, on the herd mentality of other investors in the market.
One of the arguments for the value of Bitcoin is the fact that there is a limited amount of, or limited number of Bitcoin that's ever going to be mined. I think it's capped at 22 million or something like that. I don't remember the exact number. And therefore, that provides scarcity and value to this, whatever it is that Bitcoin is. And I think that in essence, that has been used as an explanation for why this is going to have intrinsic value. And what was it, 50 million millionaires today, 85 million millionaires in the next 5 years, and everyone's going to want a piece of Bitcoin. And this is why it's a highly lucrative investable asset, if you can call it that. What do you think of that argument? Because on the surface of it, if something is scarce and if it obviously is a desirable piece of whatever, then theoretically the argument that the price is going to continue to go up holds some merit.
Yeah, I mean, there's some truth in what you're saying. Like, it is an artificially scarce or quasi asset. But there's a lot of things in the world that are like artificially scarce. Like if I were to pick, CDs made of 90s pop songs, there's a finite number of those in the world, but like nobody's trading those like as a speculative asset. There isn't a direct comparable thing to Bitcoin in traditional markets. Like, it's really hard to pin it down to something, but like if you were to pick the closest sort of asset class, it'd be like art. It's like art, but minus the art. It's basically like a piece of performance art where you sell shares in a database or a spreadsheet, and then you can swap the cells back and forth between different participants. And if you a priori accept the premise that those cells themselves have value, then you can sit there and trade cells back and forth with your mates all day, and they're artificially scarce, but they have no intrinsic value, just like art has no intrinsic value. It doesn't actually generate a yield from any cash flows. It has no consumptive value like a commodity. It doesn't represent a legal claim. And unlike a derivative, there's no actual underlying and no rights that are supplied by it. So it's basically like a piece of performance art that people can trade back and forth with each other in a giant append-only spreadsheet that's spread across the globe. And that's very weird. The only comparable thing would be like art. And so, yeah, it has no intrinsic value, but it is artificially scarce. That's correct. It's just a very weird asset class.
And it's an asset class that is basically, I mean, at the end of the day, no matter how long we talk about it, at the end of the day, it seems to come back to this belief system that it actually has value. Because technically, if I understand from some of the pieces that I've read that you've published, I mean, technically, you argue that everything that exists today in terms of more traditional payment methods and methods of exchange is, if not as good as or better than what crypto has to offer today. Is that correct? I mean, the novelty and the technology and this breakthrough that has been piped along with crypto, is it real?
Well, this goes back to the narrative, and it's one of many narratives that crypto can be used as a payment mechanism. And in some sense, it's true. You can counter trade crypto assets as a means of payment. It's just not a very good one, because you can effectively counter trade anything in sort of a barter way. I could trade coffee mugs or goats as a currency, but like they don't function very well as a currency because there are better currencies that exist, like the dollar, the euro, the sterling. And those have the property that they're relatively stable relative to like a basket of domestic goods that you would use to purchase them. And that's because of the dynamic supply that's controlled by the central bank, along with the various mechanisms we have for money creation in the economy, and the macroeconomic levers that the government has to maintain price stability of the currency. And so in the absence of those centralized controls, Bitcoin tries to create a like completely decentralized currency that has a like fixed distribution mechanism. But this doesn't actually work because that mechanism that the money supply expands doesn't actually react in response to like aggregate demand in the economy. So it's always going to have this volatility, which makes it absolutely rubbish to use as a currency because you can't denominate long-term contracts in it. So like, for instance, you could never denominate like a mortgage in Bitcoin because it's just too volatile and the price of it could go up, 1,000%, or it could go down 1,000%. And then servicing the loan would be impossible. So a currency that you can't actually write mortgages in, which are like the fundamental like foundation of our economy, is a really rubbish currency. And so really there's no broad macro use of Bitcoin or any of these crypto assets as a currency because of its fundamental design flaws. In the presence of actually good currencies, why would you use Bitcoin? Except for illegal activities.
Yeah, I mean, we talked about demand. Sasha mentioned it too, and there is a limited supply, which is going to be capped. And so something's value can be predicated on the demand for it. And if that supply is limited, then it does have a value if people want it. But I mean, in that sense, that's a bit like the money supply, the M2 in regular currencies, that the central bank has the ability to increase the amount of currency available, decrease it, and thereby can, manipulate the value of whatever your currency is, fiat currency. And in this sense, there is demand. I mean, a lot of people want it, and the supply is limited. So, I mean, doesn't that give it the basis of like the beginnings of a currency that you can use, in so much as you only have a limited number of coins, and if enough people want them, you can trade them and exchange them for real currencies.
I mean, there's that thesis, but now we've shifted back toward treating it more like an equity. It's valuable because people want to speculate and trade it rather than actually use it as the basis for like denominating contracts or for commerce, right? Because those have exactly the opposite properties. Like if you're going to buy something hoping it's going to go up in value versus you want to use it as a medium of exchange in an economy, those have like diametric opposite properties. And so, yes, you can trade Bitcoin, and absolutely you can make money trading Bitcoin in this world. But as a currency, as a money, it doesn't function very well. And as an investment, its thesis is predicated upon this kind of herd mentality, the speculative mania, and that's very unpredictable. It's just
why can't you buy anything? I mean, this is what's held me back from getting involved with it, because I can get it on my phone. My fintech app, allows me to buy Bitcoin, but I can't spend it. I mean, it's a coin that you can't buy anything. Nobody trades in it. I mean, there's a cafe here in Berlin where you can buy a coffee using Bitcoin, but I think that's the only real world application. Why hasn't anybody adopted it? Because surely if there is trade, if people are using it to buy things, then that would give it some sort of stability, some sort of solidity in its value. But why is it that no shops accept Bitcoin, apart from online gambling, which is the only real commercial activity you can do in Bitcoin, isn't it? Or if you're a drug dealer and you want to launder money?
Yeah.
Well, you can't really use it because it's too volatile. If by the time you go to pay for something, the merchant has purchased the good in Bitcoin and the price has moved significantly, then one side of this transaction is taking a huge loss on the counterparty risk. So as a currency, it's just absolutely rubbish because it's used as a vehicle for speculation. It's very good at creating a hyper volatile quasi asset that will go up and down randomly that people can sort of gamble on, but that makes it absolutely rubbish as a currency. It makes it a very fun gambling product for certain people, though.
It's got currency in the name, cryptocurrency. It's like, isn't it money or not?
Well, not by the traditional economics definition. It doesn't satisfy the three criterion, like a unit of account, a medium of exchange, or a store of value. It's neither of those three. So it's a gambling product.
So be clear about this, because the way you're talking, it's an unregulated asset, and the demand is created there not because you can use it as a currency, which you can't, partly because of the volatility, just partly because no one does. But it seems reading your blog is that the reason people go into it is they see it as an investment. They see it as something that's going to go up in value, and it just did. It just doubled in value, and then people make money out of that. But isn't this a Ponzi scheme, or at least tulips? It looks to me like tulips.
It has characteristics of both. It has the economics of a Ponzi scheme. There's no central operator behind it. It's kind of like a decentralized Ponzi scheme, but it has precisely the same economics. The only way one investor makes money off of trading crypto is from another investor losing money. It's pure zero sum. And is it like tulip mania? It certainly has these sort of speculative upswings where people trade it completely untethered to its fundamentals, of which there are no fundamentals, by the way. So it's a pure naked speculative investment. So it's sort of like tulips for the internet era.
But
it's pretty strange.
Stephen, we're talking about Bitcoin, but as I see it, there are 11,239 cryptocurrencies currently being traded on 939 exchanges. This seems, I do have quite a bit of a finance background, and I'm trying to wrap my head around this, and I still can't. So 11,239 cryptocurrencies. We're talking about BTC, obviously the best known. Perhaps Ethereum is a close second. Where do the other 11,237 of these things fit into the puzzle of the cryptocurrency game? Because quite honestly, well, how do you navigate 11,239 different cryptocurrencies, invest in them, and how do you, so in order to use them, both counterparties have to be on the same cryptocurrency. It's not like you can use Ethereum to pay for Bitcoin or vice versa. Is that correct?
I mean, you can trade them back and forth on these like centralized exchanges, but like directly, they're not directly exchangeable at the technology level.
Right. So how do you manage this? I mean, it seems completely mind-boggling to navigate this.
It's explainable.
And what prevents?
Go ahead.
And what prevents? So if I understand this correctly, anyone can launch a cryptocurrency if you have the programming skills, the technology know-how to do this, and then it's just about marketing.
The 11,000 different sort of cryptocurrencies are best explained by the fact that the cost of creating one is effectively zero. So literally any teenager anywhere in the world can create a new speculative asset from their basement and then launch it for anybody in the world to buy. And it's completely unregulated. It's completely transnational. And more or less, it's outside the remit of a lot of the market regulators in Europe and the United States. Demand for these things is given by a simple fact. People like to gamble. And people have created all of these tokens basically on pure securitized nothingness that people can run pump and dumps on. And if you happen to be with the one creating the coin, which you issue completely out of thin air, you stand to gain a lot of money if you can basically create the token, get thousands of people to buy it, and then dump your holdings, and you can make a lot of money on the back of getting a lot of retail suckers to buy it. And it's a form of crime, but it's one that's basically unpoliced, and so people are going to do it. And it's driven by the demand for gambling. It's people are playing time the Ponzi.
So if I get this right, I mean, you're suggesting that at the end of the day, these coins have no value. And if you look at, previously when we had the gold standard, then you had like a pound of gold, and British pound note, it says, I promise to pay the bearer £1. That was 1 pound of gold that was sitting in a bank somewhere that note represented. So you didn't have to carry around a big bag of gold. In the modern era, the fiat currencies, they're still predicated, they're underpinned by the hard currency reserves your central bank holds, but also the economic potential of your economy. So if the economy is booming, the value of the currency goes up. However, with this, there's nothing underneath it. But I wanted to ask you specifically about the one thing that really appealed to me about these coins is the smart contracts idea. And there was a story I did here in Berlin where there were some guys and they were setting up a real estate fund, and the idea was to buy, stores and hotels and commercial real estate, and then issue a coin. And then that would allow investors to buy a share of this building. And you had an income stream in the form of rent. And the problem with real estate investments is the way it works is the ticket size is, you have to invest, there are funds, but you have to invest $10,000, $20,000. And the idea of this was that you could fragment it, atomize it. So you could buy $10 worth of this. And in the smart contract embedded in the coin, it gave you your share of the rent, you had an income, and you could go in at any size. And this way you would vastly open up the pool of investors that could do this. And it was backed by the value of the property and also by the rental income. I thought this was like really clever, but I think the company's collapsed. It's gone nowhere. But surely these smart contracts is the one redeeming feature of these coins, that you can set up a structure like that and actually atomize investments and allow people to get in and out. And they can do it on the platform. They can buy it today, sell it 10 minutes later. That's all incredibly flexible.
At the heart of that, there's actually a very good idea. Like, could we take assets that are otherwise illiquid or stranded and then basically create legal structures around them such that we could sell the claims on those assets to a broader pool of people? That's actually a really good idea. That would, increase the size of, markets and increase liquidity on these assets. And that's a really great idea. The only issue is that when you dig into the sort of technical details about how to synthesize that with the real world, there's some fundamental problems, because at the end of the day, what you're doing is basically creating a structure, a legal structure. You're creating a security, which represents a legal claim on some sort of asset, be it the real estate or some sort of cash flow on the rents generated thereof. And you can represent this in a smart contract. This is something that's totally doable. Like, you can create an Ethereum smart contract. It's called like an ERC20 token. And you basically create a capitalization structure, just like you would in a company, like a Delaware Corp or like a limited company. And then you issue the shares, but the shares are stored in this registry structure in the smart contract, and they can be traded back and forth by anybody that can interact with the smart contract that meet the programmable logic contained therein. The problem is, what happens when there's a mismatch between the registry and the assets? Because the thing about like smart contracts is that, like, in order for you to have that share in that contract, you need to control the set of private keys, which are this way of like digitally authenticating your identity. And if you happen to lose those keys, or they get stolen or hacked, then your claim against the asset is no longer legally bound to your ownership in the contract. So what you would have to do in normal systems, like, you'd have to go to the courts and say, okay, I know this part of the estate is owned by this person, and the courts will adjudicate the fraud, right? With a smart contract, it's entirely controlled by the smart contract, which means that, like, there's nobody to go to if there's a mismatch between the registry and the actual real world ownership.
I thought the idea of blockchain was that couldn't happen. I mean, it was infallible. That once you took ownership of it, then it was yours. And the blockchain, the way it's built, means that you can check it, you can go back, but you can't change anything. And the only possibility of losing control is if you're hacked, someone steals your key. But again, I thought that was supposed to be so encrypted, so hard to do, that was impossible as well. Unless you stupidly gave your key to somebody else, password, whatever it is, then that's your fault. I mean, then you've lost it. But I thought that was the whole point of the blockchain, was that it was a permanent, indelible, perfect record that couldn't be hacked and couldn't be altered in the past. And so that once you have your property rights in the form of the contract, which gives you the ownership of the building, you have them and nothing can go wrong. Is that not true?
Well, that's the idea in principle, but the problem is that the real world is actually quite messy. So imagine, like, for instance, like you own the digital representation of the estate, right, or the building, and then you happen to pass away tragically. But you were the only person that kept your keys and say you didn't write them down or you memorized them. What happens to your claim then? It basically goes to the grave with you, and nobody can recover your claim as it's stored in the smart contract to actually like pass it on to your children or something. And so what would happen normally is that there'd be like a legal system by which you could like rearrange the capitalization structure of the legal structure. But since that's stored in an immutable ledger that can't be altered by anybody, what you have then is basically the immutable structure does not match the real world, because at some point somebody's going to take ownership of the building at that point, and then the smart contract no longer represents any kind of legal claim. It's become detached from the code and the law. And if the whole purpose is to kind of unify the code and the law, eventually at some point you need like third-party custodians to actually be the guardians or the custodians of actually what is the truth about this ledger, which point that entirely defeats the entire purpose of the blockchain in the first place. And so like this entirely, it's a plausible idea. It doesn't actually work in practice.
Yeah, I can imagine that there must be some sort of workaround to deal with dead people who own coins. But I mean, again, the question is the same. It's like, it is a good idea, it seems to me. I mean, you can create a vast pool of new investors for something like real estate fund. Why hasn't it happened? I mean, surely that is extremely attractive.
I think if you were to actually do this in practice, you'd end up reinventing like all of the institutions that we already have, perhaps in a better way, perhaps in a more digitized way that allows better straight-through processing or more liquidity. But like you'd end up having centralized actors that basically acted as like land registries and custodians and clearinghouses and broker dealers. And so if that's the whole purpose of, if you just end up recreating exactly the same structures that already exist, then the technology is not really bringing much to the table. And I claim that basically most of the smart contracts, if you were to like try to, create securities on top of a blockchain, you end up recreating exactly the same structures because people need investor protections. There needs to be broker dealers, need to be separations of concerns. There needs to be qualified custodians of the assets because people need protections from malign actors, or they need to have, courts to interdict, to actually intervene when there's cases of disputes. And that's just part of anything that touches any part of human society. And I don't see how technology can fix that.
And just to expand on another point that Ben had brought up, and that is that we were sold cryptocurrency and Bitcoin with the idea that it was really a perfectly secure instrument, and that it was very difficult to really play games with it. It was basically unbreakable. And what we have seen recently is FTX, Binance. I think that that's just the tip of the iceberg in terms of all the problems that we've seen with cryptocurrency in general and Bitcoin in particular. If the security and the immutability of the coin is not really guaranteed, and if it doesn't live up to the hype, then first of all, why doesn't it live up to the hype? Because it seemed like it was supposed to be the perfect electronic tool.
Well, we should separate the concerns here, because like from a technology perspective, the technology does work. Like nobody has hacked the Bitcoin network. In some sense, it does exactly what it claims to do, which is to create this global append-only limited writer spreadsheet that people can trade the cells in back and forth with each other. It does that like irrefutably. It's just that the economics of that don't actually make sense for what it was actually claiming to do, which is to be a currency, because of the reason we specified before about the lack of a dynamic supply, the volatility of the price. So in some sense, yes, it is secure in some sense. If you own the keys for the assets, you can control them. That does work. It's just that in practice, most people don't actually want that, because what you're competing against is basically like, I have a Visa card. I can tap it anywhere in London, anywhere in the world. I pay 0 transaction fees. My currency is stable. If there's any fraud, I call my bank up. All the transactions get reversed. The system works very, very well. So if you're competing against that versus crypto, where the price will go up and down randomly, it's subject to immense volatility, fraud with no protections. And I have to basically memorize the keys. And if I lose them, I lose all my money. You lose all your keys, you lose all your money. That's a really bad idea. So like what they're competing against is a system that works very, very well for most consumers versus a system that's designed for basically a very small pool of hyper paranoid computer nerds. And, there's just no comparison. Most people are going to choose the, well-designed, well-tested system that's backed by the full faith and credit of a nation state and has massive institutions and protections around it versus some sort of, anarcho-capitalist fantasy world that's basically built for money laundering and illicit financing.
So given the blockchain, there is a mutable record. I mean, there is some value here. And given the smart contracts, that's also bringing some value to these things. Why do we need cryptocurrency at all? Why can't we just digitize money? In so much as you've got lots of central banks that start to do that. I think the Jamaicans have been the first. They've created a digitized version of the national currency. And then you get the best of both worlds. You actually get the economy underpinning the currency. You get a regulator who sits on top of it. So there is a possibility dispute resolution. And then you can use the Jamaican dollar, or the Russians are halfway through digitizing the ruble. And you can then use that in transactions. The costs are lower. You don't have to deal with money supply. It's easy to organize because you can just, I don't know, the Russians are actually talking about deleting the coins after a certain amount of time. But there is some mechanisms to control, in effect, digital money supply. I mean, why don't we just digitize our cash, the euro, the dollar, the yen, whatever?
Well, we should be precise with our terms here, because when we say money, money for most people means commercial bank deposits, which in some sense are not pure money. They represent a liability on a commercial bank, which holds public money issued by a central bank, obviously. So there's a chain of intermediaries here. So your money that you're using at your Visa card is, strictly speaking, not public money, but for all intents and purposes, it is money. And when you go to, Starbucks and tap your credit card down, like, there's not like physical cash in like a wheelbarrow being moved between like your bank and Starbucks. Like there's two databases that like swap values back and forth, and then they get cleared a couple of days later by Visa, and which updates another database from your bank and Visa's database, and then ultimately your bank updates its balance in response to some sort of aggregate deposit holdings with the central bank. And so money is already digital across this entire chain. It's just that it's not all digital in one form. And so money has been digital in Europe for quite a bit of time. I mean, London is basically like a cashless society. Most of Europe is, with SEPA and faster payments. Money is quite digital these days, and like it's quite rare to actually use physical cash these days. So money is already quite digital.
My phone for everything now. I've got to the point where I don't carry a credit card anymore. And I can tell you in Germany, that's actually unusual because lots of people don't take cards. And now they're starting because they have to, because people like me just simply, not only do I not have a credit card, I don't have any cash. So I mean, what's the point of digital currencies if we've already done it? We've gone digital.
That's my broad point. Like money is already digital and it's actually quite good. So if you have a digital form of money that already works quite well and you have a rubbish one that doesn't work very well, maybe we should use the one that works very well already, which is the one backed by the full faith and credit of a nation state.
Isn't the key issue here? Because I mean, on the pound, it says, I promise to pay a pound, trust. The US dollar, it says, in God we trust. Trust. The essence of money is trust. And you were talking about this digitization, currency, Starbucks and me buying a coffee. However, most of the money in the banking system is not actually there, in so much as if I deposit $100, then the bank will keep $8 in cash in the register in case I want to take it out again. and then they will take the other 92 and lend that to other people, always in increments of 8%. And consequently, the bank has liabilities of thousands of dollars off my $100 bill, which is why if we all go and ask for our money at once, the bank collapses because it doesn't have the money. And the issue with the Bitcoin, the cryptocurrencies, I mean, they don't have this trust because at the end of the day, the currency itself is predicated on the value of the economy, but there's also like deposit insurance guarantees so that I can get my money back. Somebody's going to have to pay, probably government or the funds. Isn't that another fundamental difference between, because the system we use now is actually not, it's the same like hokey pokey money we just invented out of thin air, but it works because everybody doesn't take their money out at the same time.
You're absolutely right. I mean, money is trust and it's credit at the end of the day. And those two things exist within a society and a legal system and a regulatory framework. And you're right, the bank doesn't hold all of your money. It does maturity transformation, it loans it out into productive activities. It doesn't control actually most of your money. But there are controls around what the bank can do in terms of its deposits. There are insurance safeguards so that like if there is a bank run, people will be insured and backstopped by the state. And there are still bank runs that are possible. And there have been lots of cases of this in the past. But like in aggregate, like massive shocks in the West where like all banks go insolvent don't actually happen anymore because of the system that we've put in place. And I'm not saying it couldn't happen in the future, but like it doesn't, broadly speaking, happen in recent memory.
I'm trying to work out the attraction of this, in economic terms. I mean, the smart contracts, I really do think is something that you can do interesting things with that money can't do. But I'm struggling to actually see the point of using a cryptocurrency which is not backed by anything in place of money. And I don't know, it just doesn't seem to make sense to me. Why don't we just use existing money? We can digitize our existing money and add smart contracts to that. And if we have an official digital version of the pound, dollar, euro, whatever it is, isn't that right?
That all sounds very sensible to me. I'm not a fan of cryptocurrency. I think it rests on economic contradictions and it's strictly worse than things that we already have. The issue with smart contracts, though, is it sounds like a very good idea. Like if we could like digitize more of our commerce and like take arrangements between counterparties and digitize it so that they could be disintermediated by computers, that would be very cool. It's just in practice, you typically want to have like discretionary controls around these things and like a human in the loop. And so there's kind of a limit on the digitization that you can actually do in practice. So like most smart contracts, if they were to be deployed in the wild, would probably be just centralized computer programs detached from the blockchain and the crypto assets. And that's already existing in financial services. We call that either disintermediation or straight through processing. And that's been part of what banks have been doing in IT departments for like almost 10, 20 years now. It just doesn't get much press because it's basically just like kind of routine digital transformation that's already happening. And you can call that smart contracts, but at the end of the day, it's basically taking legacy systems that are based on paper, emailing Excel files around, two guys calling each other up, and basically replacing that with a computer program that does all of the communications and the payments behind the scenes. And that, broadly speaking, is a good thing for the economy because better markets and less, more automation is, broadly speaking, good. I just think that the name smart contract is a bit misleading.
But one last related question. Are there any technical limitations on this? I mean, I read again in one of the things you were writing that the dissemination, because the blockchain, because it's so complicated, this immutable contract that's created, it takes enormous amount of power, of computing power and electricity too. I mean, this is another thing I have a problem with blockchain. The amount of power, electric power you need to create them seems to me it makes them unviable. The Georgians set up a special farm for mining coins, but then it was eating so much power, they actually built their own hydropower plant next to it to fund it. But you were saying there's a limit to the speed that the dissemination could go, which puts a limit to the contracts, to the transaction volume you can do. And actually it runs too slowly to be able to run a country on it. You could run a store at that speed, but not a whole country. Isn't that a limiting factor as well?
Correct. Although we have to kind of distinguish between there's like 11,000 of these things and some that have different technical specifications. But Bitcoin in particular runs on the system called proof of work, in which computers around the world race to solve basically an inverse math problem. And whoever comes up with the solution the fastest gets a certain reward, and they get to confirm a certain set of transactions from the rest of the network. So this gives rise to the fact that it's very hard to like interdict transactions on the network. It's because it's spread so diffusely across so many different computers. For them, that's basically a design feature. What it fundamentally limits the throughput of the network to be something very, very small relative to like national currencies and clearing systems that exist in developed economies, because those run on centralized servers. So Visa can process, hundreds of thousands of transactions a minute because it runs on a very small pool of servers set up in a data center somewhere in a local jurisdiction. And because everything goes through one point, those computers just have to be really, really fast, and they have to be connected to a very, very fast network. But that's the fundamental limitation. And computers these days are very, very fast. Now, if you spread that computation across the entire globe, and you have all these computers that have to like solve math problems every time somebody wants to pay for a coffee, you basically have a system that can basically run like the scale of like a small supermarket, but not enough to run like a global economy. Because ultimately, in order to make these systems scale, you have to centralize them in very, very small pools of trusted companies that run very small data centers to get the throughput you need for global commerce today.
Stephen, am I right in my perception that Bitcoin? I mean, if you look at if you look at currency in general today, it actually creates value. I deposit money in the bank lends it out, it goes into the economy, it creates new businesses, it creates economic activity. That doesn't seem to be the case with Bitcoin. It seems like it's a very parasitic instrument. Money goes in, Bitcoin doesn't really create any sort of follow-on economic activity, or crypto. We keep using Bitcoin, but let's say crypto. So it's if money goes in and nothing goes out, this does not seem to be like a good mixture for the future of currency in the global economy.
You're very correct. I mean, maturity transformation is the basis of our modern market economy. It's what makes the entire economy go round. Crypto is, like I specified, it's basically a form of gambling. If you imagine like you go to a poker game with a bunch of your mates and you stack the chips and you can like gamble on the rounds, but ultimately all of the money that can be won in that game is the money that people brought to the table. Money may change hands, but nothing's actually being produced in the world. This is a completely non-economic activity. You're just shifting money around in a pool. And crypto is basically just the zero-sum form of gambling in which people can like trade whether the price is going to go up or down. But at the end of the day, it doesn't actually produce anything. It's not making loans. It's not creating new businesses. It's a form of naked speculation, completely detached from anything in the real economy. And it is quite parasitic in the sense that it's used almost exclusively by people that can't use national currencies, which is basically to say, terrorism financing, money laundering, tax evasion, sanctions evasion. So in some sense, it's negative sum gambling tied to things with massively negative externalities in the world. And that is quite predatory and parasitic.
I've in some of the conversations that I've had with family offices in Europe and the US, the demand for Bitcoin currently as an investment, dare say, asset class, is extraordinary. And a lot of the demand is coming from the Middle East. And so, so going back to where we started in terms of what Bitcoin is used for and how it may be financing terrorism, wars, and whatever else, or sanctions, or circumventing sanctions. That does have a certain correlation to what is happening in the Middle East today. Because if I looked at the dates in terms of where the Bitcoin recovery started, and it's basically 2 or 3 days after the war in Gaza. So this I mean, it's a confirmation or at least an indication of the fact that the real use of this instrument is for either criminal activity or to finance nefarious actions of very strange government. So if that's the case, why hasn't the West taken a closer look at least regulating this instrument, or setting a set of guidelines that will allow them to control or at least monitor how this is used and who it's being used by?
Those are complicated questions that touch on like the global state of geopolitics. The United States is doing some regulatory actions. Obviously, they perceive all of these institutions as being financial institutions, and if they're serving U.S. persons, then they fall under the remit of the Bank Secrecy Act. They have to comply by U.S. sanctions regime if they're going to touch dollars, which a lot of them are highly contingent on dollars. So they just been quite slow on the enforcement actions for reasons that are still a mystery to me. They've been catching up in the last couple of years. I would chalk a lot of it up to there's been a very drastic shift in the regime in the United States since 2020. And obviously with the changing administration, there's been different attitudes toward how much of this we want to clamp down on. Some of that's politically driven. Some of it's driven by the fact there's been, massive fraud that we saw in the last couple of years with the FTX and the Binance suits. But the reality is the governments are just always slow and behind the game compared to the activities that go on in the normal financial system and in technology. They probably will ramp up their enforcement actions against these institutions because effectively what a lot of them are doing are basically creating counterfeit US dollars that are basically being used to undermine the foreign policy interests of the United States. So I can't imagine that's going to, persist indefinitely. But you also have to realize like the scale of the entire industry is quite small, right? Like the entire crypto industry is by some estimates like less than $1 trillion. Like the market cap of like Microsoft is roughly equivalent, and that's like one company on the S&P 500. So relative to like global macro finance or like US capital markets, the crypto market is basically like a small little dot. It doesn't actually matter that much. And if you were to look at all of the money that's actually associated with crypto financing, most of it's located in like Liechtenstein or Caribbean islands. And it's relatively small because like it's all being banked at one or two or three different banks. So if the US really wanted to enforce their policies, they could lean on those countries and enforce them. Why they haven't done that though yet is a mystery to me. But I imagine this current era of lawlessness can't continue indefinitely because the only use case of crypto is really crime and evasion of US.
Are there a lot of institutional investors? I mean, institutional money in crypto? Because you make it sound like it's largely a retail thing. It's the guy in the street who's speculating in the hopes of get rich quick scheme.
Well, exactly that. There's a lot of institutions that see the sort of so-called dumb money that's flowing in from retail, and they want to, trade the markets because everything that's been illegal since the Securities Act in the 1930s is legal in the crypto markets, or it's not enforced. And so naturally, there's a bunch of hedge funds that want to trade that because they see a liquid set of markets populated by unsophisticated investors, and they see a way to make oodles of money. And a lot of them have made oodles of money on the back of, fleecing retail investors. And as far as I can tell, a lot of that's been unenforced. So naturally, in that kind of environment, you're going to see less than scrupulous actors come in to exploit information asymmetries and unsophisticated investors. So that's where the institutional money is coming from.
You suggested that should cryptocurrencies solve the basic problem of the volatility in the value, which prevents it from being used as money, if that happens, then all the institutional guys would leave, and that the retail investors would be left holding the can because, like the tulip mania, the bubble bursts and suddenly a tulip is just a flower again and worth 1 guilder instead of 50,000 guilders, and the whole thing falls to pieces.
Precisely. If the possibility of having parabolic returns went away and like the volatility subsided and like Bitcoin was flat, there'd be no interest in speculating on it anymore. It would function as a currency. Now, the only way that would happen would be basically replacing its algorithmic distribution mechanism with this like a central institution, like a central bank, which would undermine the entire purpose of crypto in the first place. So in the absence of them basically taking their decentralized network, turning it into a centralized system, it's always going to be a vehicle for speculation. And basically, like I said, it's just a gambling product at that point. If it can't function as money, it's just an investment for other institutional investors to trade against each other in a zero-sum game, which produces nothing.
Yeah, Stephen, but isn't the decentralized nature of Bitcoin itself sort of a safeguard against effective regulation? Is it technically possible for governments to actually go in and regulate this and actually have oversight?
It's quite a challenge because like these networks will exist so long as there are two people that want to run the code and transact with each other. And that will probably never go away, so long as there's two computers running the source code, which governments can't really change. What can change is that the reality is that most people are buying cryptocurrencies for price appreciation. They want to make more dollars. They want to buy low and sell high. So if we remove the capacity to actually exit your positions from these centralized exchanges by limiting their banking access, you fundamentally would shrink the market down, and you would decrease the interest in actually speculating on these things because you couldn't actually withdraw into dollars anymore, which would remove most of the raison d'etre of actually trading these things, which is to get more dollars.
Well, Ben, do you understand crypto any better now?
Not really. I
I
still
think
don't.
every time I speak to Stephen, I always walk away even more convinced that this seems like a scam for the ages.
Yeah, it is. I mean, I mentioned tulips with reason. I mean, it just looks like that. People want
Yeah.
to make money, and if you come up, it's just repackaging the age-old idea, isn't it? It's like people want to be rich, and here's a tulip, and you can buy that, or here's a Bitcoin, you can buy that, and you'll get rich very quickly for doing nothing. And it's the same thing. It just keeps recycling, but maybe the government. And the other thing is, it's just the obviously criminal nature of it. That it's used by terrorists, it's used by drug dealers, and it's used by online gambling. And those are all businesses where you can't use dollars because they leave a trace. So I don't know. I think the whole thing is rather unhealthy. But like I say, it's on my phone. I can buy a Bitcoin, click of a button with real money. It's just once I bought it.
Have you ever?
I did. I just,
Have
it
you
was there.
ever?
So I bought 50 euros just to see what would happen, to get used to it, and I lost money. So I sold it again. And so that was my Bitcoin experience.
I mean, there's nothing
So,
new under the sun. I mean, it's basically just a form of gambling, and gambling is quite popular. And so long as people want to gamble on it, it will exhibit volatility, and people like that. That's the feature of it. But at the end of the day, it's just a form of gambling.
No, look,
well, at least in gambling, there's a game involved. Here, it just seems like you're shoveling money into a rigged house.
I
Yeah,
got
it's a rigged market.
because I used to live in Moscow as a correspondent, and I've got friends there, and I wanted to send some money to Russia, and you can't now because ruble exchange has been blocked. And the thing is, you can send crypto. That is an option for getting money in and out of Russia, which and everyone's getting raped on the exchange and the fees for that. But it's because it's unregulated. And so that did actually interest me. It was here is a way of operating outside of the system and transaction with all these countries. We have correspondents in Iran as well, and it's also impossible to send money there. But is that a good thing? I mean, to create this infrastructure where you can send money that's totally outside the system, totally unregulated. And it's kind of convenient when all these countries are having a go at each other and banning each other's transactions. Because life goes on, and you have friends. I have Russian friends who are actually nice people. I want to, be able to interact with them. But it makes you wonder, because as I say, being a business journalist, money is trust. It's based on trust, and you need a system that's trusted and regulated. And if you don't, you invite crisis, chaos, collapse. There is a point to having governments who are supposed to have sensible regulations. So setting up a money system that's completely outside of that and totally resistant to regulation, isn't it? I mean, they don't want it in any shape, form, do they? people who run these
Well,
things.
isn't Coinbase fighting to get the U.S. government to put in place regulation because they see value in getting more transparency and more regulatory oversight?
The crypto industry is spending hundreds of millions of dollars on lobbying in the States to get them to bring crypto assets under their desired regulatory framework and classify them as commodities versus what the government wants to classify them as securities. And there's not a lot of political will to actually do that anymore because of what's happened in the last couple of years, because naturally when you create a system whose purpose is, gambling and crime, these are not, socially acceptable things. And the externalities of them are so vast that there's not a lot of people that are willing to stake their political career behind the industry at this point. So they can keep fighting, but they're fighting a losing battle, I think.
So in essence, what you're saying is that this is, and once again, this is sort of a nefarious. There's they want regulation in order to basically legalize illegal activity. That, if I understand you correctly.
Yeah, I mean, their entire business model is predicated on, fueling gambling and illicit financing, and they want to bring that under this sort of gray area in the financial system where that's allowed to exist. And that does exist in American context. Like there are plenty of companies in the United States that are like payday lenders or like, pyramid schemes that are allowed to sort of operate in this gray area. The Americans are quite tolerant of such things. So there's not without some precedents that this could happen. But time will tell what happens with the American regulatory regime. But what the current administration right now is quite hostile to it.
And the 1.2 trillion, whatever that constitutes the crypto market today. I mean, in the overall sense of a global economy, that's quite small. But if you narrow that down into specific areas, that's actually quite a lot of money that's being funneled around. I mean, if you're looking at criminal activity, or if you're looking at funding terrorism, or if you're looking at circumventing sanctions, that's quite a pool of capital to work with in order to avoid sanctions or prosecution.
Well, that number, we should take that with a grain of salt, because like that's the notional like market cap value of all crypto assets combined. The problem is that it's a deeply illiquid market. Like if most of these coins, of the rich like 11,000 of them, if you sold even like 1% of the total supply, like the price would probably plummet like 50-60%, as we saw in the FTX collapse. Now the question is, how much leverage is actually baked into the whole crypto ecosystem? Well, we don't know how much real money is actually sloshing around. We know it's probably a lot less than the notional market cap value. And you can kind of quantify the institutions involved with it, because like Coinbase is a public company. We can look at their books. We can look at the total size of like the Bahamian banks. And we can look at some of the institutions in Switzerland and Liechtenstein and look at their total deposit balance. So you get a kind of cap of what this could be. But, it's not anything close to $1 trillion. It's probably somewhere in the hundreds of millions, which is actually relatively insignificant on the global scale.
Correct me if I'm wrong, but wasn't there a case that I think about a year ago where it actually turned out that a lot of these interactions between the crypto exchanges were underwritten by basically nothing? And so actually the knock-on effect in terms of these companies or these exchanges going bankrupt or whatever was actually significantly higher than the value of the Bitcoin that was being traded or used as security.
Yeah, there's all sorts of financial shenanigans that are going on in this industry, especially on the non-public companies. Like FTX was famous for like issuing their own like token and then putting that directly on their balance sheet with like the mark-to-market value of the token. So basically, we like JP Morgan basically putting JP Morgan stock on its balance sheet. It's kind of a like financial perpetual motion machine. And naturally, when the value of the thing tanked, obviously the whole structure imploded. And there's a lot of these kind of, let's just say, clever financial engineering going on to prop up this market. And a lot of it's predicated on, wash trading back and forth between institutions and lots of leverage and loans between different shadow banks. And this all looks like we've seen the story about how this goes before. And like the only saving grace is that the size of this whole thing is actually relatively small relative to like what happened in 2008. So probably not going to have the same kind of structural collapse. But at the same time, we're seeing shades of 2008 happening and being recreated in an even less regulated environment. And that should cause some systemic risk concerns to anybody that's watching markets.
As a parting note, what do you see for crypto or Bitcoin over the next 5 to 10 years in terms of is there a future, or is it tulips all over again?
Oh, I am not an oracle or a prophet.
But as a professional, as someone who knows a lot more about this than 99.999% of the world, what would you say in terms of what your expectation is?
Well, from a purely normative stance, I hope it all goes away so I can retire from actually talking about this stuff because it's all so absurd. But like as Warren Buffett said, like the markets can remain irrational longer than you can remain solvent. And I underestimated how irrational the markets could actually get. And it turns out in the sort of social media internet era, like tulip mania actually takes on a whole other level. And that's what I think this is. I mean, it's just speculative media, just like you've seen throughout history. Like Charles Mackay wrote a whole book about like extraordinary popular delusions and the madness of crowds. This is the latest iteration of that. Nothing is new under the sun. Like this all happened before, it'll all happen again. How long it's going to go, God only knows. I hope it ends soon because it's quite mental what's going on, but I can't predict the future. And it could very well, if this stuff sticks around for quite a while. Who's to say? It's gambling at the end of the day, you know?
Then, like Buffett said, the tide will go out and we'll all be naked. So that, don't know, is that a nice image to finish the session?
The emperor is quite naked, actually.
Stephen, thank you very much for your time. Thank you very much for your insights. It's been a pleasure. And I wish you all the best. I know you've had a tough going saying what you're saying. So good luck.
Yes, thank you very much. It was very interesting.
Pleasure talking with you, gentlemen. Cheers.
All the best.
Thank you, Stephen. All the best.